stop. I need you to put your phone down, take your eyes off the flashing price screen for a moment, and take a deep breath. If you're holding SLV, PSLV, leveraged ETFs like AGQ or mining stocks, and you're watching your account turn blood red after the recent violent sell-offs, I'm asking you to place no buy or sell orders until you've watched every single minute of this video. The financial market has no room for sympathy, and it has just delivered a painful blow to those who overused leverage. I know exactly how you feel right now. Caught in chaos between the urge to cut losses immediately to preserve what's left, and the reckless temptation to inject more capital to get revenge on the market, hoping for a miracle rebound that will get you back to shore as fast as possible. But wake up, because throughout investing history, both panic selling and blindly averaging down without fully understanding the game have been death sentences for trading accounts. In today's video, I'm not here to whisper empty comfort into your ear or throw out unrealistic predictions about prices rebounding soon, just to make you feel better. Instead, we're going to perform real surgery on your portfolio. I'll decode the brutal truth behind how paper silver actually works, why your account is evaporating at a blistering speed, far faster than the decline in global silver prices themselves. More importantly, I'll give you a precise action blueprint, an emergency exit protocol, so you can not only survive this storm, but also learn how to restructure your capital and come back stronger. This is the moment to set all weak emotions aside and start behaving like professional investors, trading with a steel-hard strategy and a cold, disciplined mind. The biggest mistake, and the fatal flaw most investors fall into, is lumping all silver-related assets into the same category. You see silver prices falling on the global chart and assume your assets should fall proportionally. Reality has just slapped you hard. You must understand that physical silver, fully backed ETFs like PSLV, index tracking funds like SLV, and especially leveraged monsters like AGQ or mining stocks operate under completely different risk coefficients. Why does a modest 5% pullback in global silver prices translate into a 15-20% collapse in your AGQ position? That's not the market's fault. It's because you don't understand leverage decay. Leveraged funds are designed to track daily price movements, and when the market moves sideways or becomes highly volatile, sideways down, the mathematical mechanism quietly eats away at your capital, even if silver doesn't fall further. You don't actually own a single ounce of silver when you buy these instruments. You're holding a high-risk derivatives contract where time itself is your greatest enemy. Without a perfect entry and an immediate explosive move, leverage becomes a double-edged knife that slices your account a little more every single day. To stabilize the current situation, I want you to perform a positioning exercise I call the decision triangle. Draw 3 points: time, risk tolerance, and original objective. You must be ruthlessly honest with yourself. If you're using spare capital with a 5-year horizon to buy PSLV, then these drawdowns are, in fact, opportunities to accumulate at discounted prices. But if you're using borrowed money or funds meant for essential living expenses to gamble on AGQ over a few days, you already lost the moment you placed your first trade. Debt pressure and the fear of total loss will paralyze your brain, leading to the worst possible decisions at the most sensitive moments. Based on that framework, we divide the rescue mission into specific groups. For those holding SLV or PSLV, my advice is simple. Close the laptop and stop staring at the screen every hour. Chasing every flickering candle only erodes your willpower and drags you into the psychological trap of selling at the bottom. This is a game of patience. However, for those holding AGQ or small-cap mining stocks with losses exceeding 30%, you are now in the red alert zone. Dumping everything at peak panic may be unwise, but adding more money to average down is financial suicide, purely throwing money out the window. The correct plan is patience. Wait for technical rebounds, which almost always follow aggressive sell-offs, to begin reducing exposure. The goal is not to break even immediately, but to shift capital from ultra-high-risk assets into more stable ones such as physical silver or non-leveraged ETFs. You must preserve your troops before thinking about counterattacking. Have you ever asked yourself why 90% of retail investors always end up paying the bill for the profits of large institutions? Why are they so eerily precise at buying the top and selling the bottom? That's not random. The financial market is a psychological battlefield where sharks weaponize your fear to accumulate assets at cheap prices. Look at strategic reports from major funds and how they operate their prospectuses. When the crowd starts screaming on forums, when sentiment indicators hit extreme fear, that's exactly when institutional algorithms begin triggering staggered buy orders. They understand that humans are inherently fragile in the face of red numbers. They wait for you to capitulate, to crack under leverage pressure, so they can absorb your entire position at the deepest possible discounts. The loss you see on your screen, whether it's $5,000, $50,000, or $500,000, is still just an unrealized paper loss. It only becomes a painful reality when you allow fear to override reason and hit the panic sell button. When you do that, you officially accept defeat and transfer your assets to someone more patient. Ask yourself honestly, are you a strategic investor or just prey running through a maze? Hard evidence from centuries of precious metals market history proves an unbreakable rule. The market consistently punishes the impatient and rewards only those who can control their breathing. This is not the time to complain or blame an unfair market. This is the moment to prove your resolve by executing discipline. Remember, real wealth is not created by perfectly calling tops or bottoms. It is forged by standing firm when everyone else is running for the exits. Don't let yourself become just another sad statistic in the year-end reports of major investment funds. We've traveled a long journey, from facing harsh reality to building a scientific escape roadmap. Let me repeat this clearly. The financial market is not a place to get rich quickly through emotion. It is a filtering machine. It filters out those who lack knowledge, patience, and discipline, making room for those who treat investing as a serious profession. This silver price storm may damage your account in the short term, but it must not destroy your investment mindset. To give you a concrete tool, beyond words in a video, I've carefully prepared a special PDF. Risk Management Handbook and Portfolio Restructuring Strategy During Market Crashes. Inside, I detail key support levels, how to calculate safe leverage ratios, and a step-by-step process to rotate from risky ETFs into safer positions without sacrificing recovery potential. To receive this document, the process is simple, but it requires commitment. Subscribe to the channel and turn on notifications to prove you're a serious long-term investor. Then leave a comment below with the keyword plan, along with the asset you're holding, for example, plan AGQ. My team and I will personally send you the document and respond to your most specific questions directly in the comments. Never forget this. In this market, knowledge can be bought with money, but discipline is earned through experience and pain. I'll be here walking alongside you, not only during booming markets, but especially during storms like today. Turn off the screen, spend time with your family, take a deep breath, and we'll meet again when you've regained clarity and are ready to execute the plan. Goodbye, and I wish you the strength to win this game.